questions, please place them in the chat, and then I will pose those to the esteemed gentlemen once they've done their presentations. That way we make sure we get through the presentations and we don't suddenly run foul of time. We're going to stick to time as best possible, so there'll be about 45 minutes of presentations, and then we'll have questions. If we don't get to all the questions, Muni Warini, as they say in Scotland, we will post those to Russell and Philip, get the answers, and then post them up on the web page. Make sure they get to you. Without any further ado, it's Russell up first. Russell, the stage is yours, sir.
Thank you very much, Gavin, and thank you very much for everybody that's joined this presentation today. Ooh.
Russell? Is
Can you hear us?
there we go. Yes, we can hear you now.
Sorry, we seem to also suddenly have gremlins on our side, so sorry about that. Thank you very much for the introduction, Gavin, and thank you very much to everybody for the time that you made available today. So the topic that was chosen today was all about insurance, and it's that almost a swear word in some languages, but we're trying to see if we can give you some guidance on to the reasons why value seems to depreciate, but our insurance premiums are going up. So today is all about, I'm hoping that I can give you some insights into the reasons for that, but also how to actually then, at the end of the day, address these concerns of yours and how you can approach insurance differently when you look at your risk and try and improve on it so that you can improve your insurance premiums. So, in the trucking and logistics industry, we've got this paradox of, vehicles, equipment, facilities, buildings, the stock, etc. Those things are depreciated yearly, almost daily as well. And it's especially frustrating for current, if you look at it into the current market, that we need to run a business. We need to be able to make a profit. And it's frustrating. We've got depreciated values, but insurance premiums go up. So I'll just go into some of the reasons for that. Let's just move on. So why are asset values going down? So with regards to asset values, we all know I think a lot of us have had some accounting matters behind us, learnings behind us. You know that when you buy a new vehicle, trucks, trailers, equipment, and so on, as they get older and they run up some mileage, their market value actually reduces. So the time that you actually have used it, when you come to sell it, it's going to be less valuable. Then you look at today's truck or today's vehicle is actually almost obsolete tomorrow because there's new products coming onto the market that are a lot better, it's more efficient, it's got better safety. So again, it reduces the value of the existing truck that you've got. And then also, obviously, we're living in South Africa, so fluctuations in the economy, so the broader economy, so we've got inflation, etc., that impacts the prices of vehicles coming in and older vehicles. Sorry. So now let's talk about why are the insurance premiums actually increasing. So I'm going to almost come to almost the same reasons why values of trucks are going down. Number one, we've got in South Africa the high inflation. So if you actually buy a spare part today versus buying a spare part tomorrow or in a month's time, you're going to pay a different price. Similar to your basket of goods. If you go to the shops, today's milk and tomorrow's milk is going to be at a different price. We all understand inflation. The currency fluctuations, South Africa having to compete our rand versus the US dollar. So a couple of years ago, we've had a rand to the dollar exchange rate of 15. Today, it's almost 19. It fluctuates like that. So again, we have to keep up with those changes. One of the other impacts that we've seen over the past couple of years since COVID is actually delays in trying to get parts and equipment supplied through to South Africa. And it's not just a South African phenomenon, this is almost worldwide. We've got global supply chain disruption. So, we've got delays in the shipping liners, we've got delays at ports. South Africa, we've seen that. We've got challenges with rail systems, etc. So these delays actually also impacts on trying to repair vehicles, repair equipment, etc., or replace vehicles and equipment. And these impacts, obviously, the value of a claim. What we've also got is in South Africa, we've seen it, or when you drive the roads, we've got failing infrastructure. Some of the infrastructure, we've got potholes, etc., roads being washed away, etc. And also just the simple thing as a windscreen claim. So we drive the roads and suddenly a windscreen is cracked and we have to replace those. We've got rising claims frequencies and severities as well. We've got vehicles being overturned, when they drive. We've got the crime. And how do we address these things? We've got also, we've seen the KZN flooding a couple of years ago, but we've also seen in the KZN the riots that caused a lot of damages to vehicles. And it depends on where you drive your vehicles and trying to avoid those areas. Then there's other things like regulations, etc., that's going to make an impact on it. Compliance pressures. We see the auto, the rules might change. The changes in that licensing, etc. But then also in South Africa, we're not. If you look at the likes of the Santam insurance, the Old Mutual insurance, those insurers also rely on international insurers. So the funds that they've got as Santam and Old Mutual and Hollard, etc., they also buy reinsurance and any changes in the reinsurance market. So they buy the insurance from the reinsurance markets who sit outside of South Africa. They're internationally. So they get affected by international claims. And that then again impacts the South African markets. So I'll just give you a couple of other insights into insurance. So portion of your insurance premium, it is not just based on the value of your asset, so the vehicle itself. There's a couple of other aspects that you need to take into consideration, and this is dependent from client to client. So the frequency and severity of accidents and thefts. So if your fleet of vehicles, for instance, have more accidents and theft, you're going to unfortunately pay more than the client that's got the same size of fleet, but they don't have the claims. Then also the type and the value of cargo that you transport or store, dependent on the value of the cargo. So if you're going to transport high value goods that's theft attractive, unfortunately you will pay more because it's a riskier load of goods that you're carrying, and the likelihood of actually having a theft claim, is higher than the one that's just conveying widgets or bolts and nuts. The routes and the regions that you also drive with vehicles, dependent on which routes you take, which areas you focus on. We know that the Gauteng area have got a higher rate of theft and hijackings than some of the other areas. And then also the risk management and security practices, the choice of your drivers, are you making sure of your drivers actually having the right licenses in place, etc., and have they got the experience? It's all about those aspects. So even if your physical asset actually loses the value, the overall risk profile is extremely important, and it's how you actually present the risk profile to the insurance market, so to the insurers, to say, I'm actually a better risk than a neighboring customer of yours because I've addressed all of these concerns. I don't have claims. I try and make sure that our routes are properly aligned with less riskier areas, etc. So a couple of other items that I want to just mention in here. So when you look at two differences of actually insuring your assets, you've got two types of assets. You've got your buildings assets, and then you've also got your vehicle assets. So how should you declare and how should you insure the likes of your buildings? So buildings are based on replacement value, so the actual new replacement value of your buildings and equipment. Why is that? It is so in the event of a catastrophe loss, you want to be able to put into the same position. You might have to they have to demolish the building. You need to rebuild the building, and the new replacement value is what you need there. Then if you look at vehicle insurance, but why is this different? Now we're talking about the retail value of a vehicle. So what is the insurer going to pay out if my vehicle is in a complete total loss situation? The insurer is only going to pay out the retail value of the vehicle. So when you declare or insure your vehicle, you base it on the retail value. But importantly, when you look at the vehicle insurances, you also need to take into consideration the amendments that you've got to that vehicle. So you would have added some accessories to the vehicles. It could be bull bars, bash bars, all kinds of interesting things. Those things need to be added to the value of the vehicle that you insure. When it comes to a total loss scenario, again, the insurer is going to pay you out for the retail value of that vehicle. But what happens in the event of a partial loss? So you've only bumped the vehicle and you only need to replace the fender and the front lights. The insurer have to, again, now they have to go and purchase new parts and components. So they're not going to replace it with secondhand. They need to put in a new fender and a new light. And it has to be OEM standard, especially when that vehicles are still under warranties and guarantees. So now it's actually more expensive in certain situations to do repairs on a partially damaged vehicle than on a total loss value. So what are some of the risk management solutions? I mentioned earlier on, it's all about how you treat your own risk and present it to the insurers in terms of what they then deem your risk insurance premium should be. So importantly, how can we manage these risks? I'm just going to highlight a few. There's a lot more detail into this, but driver selection. Making sure that we select the right drivers with the right licenses and also annually test them. Make sure that their eyesights are still on par, they can see where they're driving, etc. test even the hearing, etc. Put them onto driver training courses, making sure that they're familiar with the vehicle, making sure that they know how to maneuver the vehicle in certain situations. Then the vehicle itself, it's very beneficial to not just have a normal tracking device, which is great for in the event of a theft to try and track and trace the vehicle. But if you have those video recording devices, so the in dashboard cameras, in the event of an incident, you've got proof of where the fault lied. And if it was a fault of another driver or a vehicle, or whatever the case may be, you've got proof of where that incident happened and who should be held liable in the event. But it also helps you in terms of when you look at tracking and telematics and so on, to determine which routes are the best. And, if you've got a system that can flag, try and avoid a certain area because we've just picked up that there's rocks in the road, or there is a problem on the road, maybe a rioting being carried out there, you would avoid those. Then some of the um, other areas that you can look at is also supply chain. And so it's all about, if you have a fleet of vehicles, if you can almost have let me put it this way, if you've got almost, you're going to replace windscreens on a regular basis, and you actually partner with a supplier and you negotiate good rates for improving on that, that would be great. Other security measures, where do you leave these vehicles when it's on the road, halfway between point A and point B, where it's a 12-hour drive? Where do you park the vehicle overnight? And cargo, what cargo do we have? What security do we have? Should we actually employ another security provider to follow us if it's really high value cargo? So all of those ideas you can use in terms of managing the risk. There's one thing that I want to just quickly touch on is the change, and you would have seen it especially overseas, where they're starting to introduce EVs, so electric vehicles. And it's not just electric vehicles, but it's the trucks as well. So because it's a relatively new risk around the world, and especially in South Africa as well, we need to understand the risk associated with converting or changing over from the normal combustible vehicles to an electric vehicle. The cost of repair of those vehicles are different. It is much higher because of the battery component. There's also less local expertise in terms of repairing those vehicles to OEM spec. Charging infrastructures. Again, the lithium battery is actually a very high risk component on those vehicles. And if by any chance there's a fire on those vehicles, the lithium battery, if that catches fire, catches a light, to try and take out the fire is extremely difficult. And we've seen situations where vehicles have caught a light, and the amount of water, you can almost drain the vehicle, put it into a tub of water, and taking it out 2 days later, it would reignite. So there's big risk in electrical vehicles. Then also the insurance market in South Africa, because they're not so confident with electric vehicles, they feel a little bit more, it's more of a risk to them. So not all insurers actually take on those risks. So in conclusion, just with regards to the motor and asset insurance, so what can the logistics and trucking companies do? Again, let's invest in the drivers and the fleet technology. Let's plan for supply chain delays. If we can get some components in advance, that would be great. Prepare for your EV integration if you are going to look into that. But importantly, work with experienced brokers who can actually make sure that they understand your business, understand your risks, give you guidance in terms of managing those risks and ensuring that the insurance coverage that is purchased is in line with your requirements and your risk, and how they then also present that risk to insurers. But also, stay informed and adapt, monitor the industry trends, look at different vehicles, look at the regulations and technology development, etc. All of those things will make sure that you are a better insurable client, as well as improve on your insurance premiums. I think I will, at this point in time, hand over to my colleague just to talk to us about cargo and transport marine insurance.
Thanks, Russell. Good morning, everyone. I think there's also the other side of this where you got your assets and fleet that you obviously need to address that risk, but also want to jump into the transport logistics, more of the cargo side. And I think there's quite a lot of information we're sharing in terms of the presentation. Some of it we're going to leave. I believe it's going to be shared with you a bit later. So on some of the slides, I will skim over because it might be a bit content heavy, but very relevant and might really be of help. I think just in terms of transport and logistics, we're moving into a new area where, technology is evolving at a rapid pace. You've got trade that's constantly putting pressure on business. Your weather components are all over the place and sometimes very difficult to predict. And also workforce changes that challenges companies on a daily basis. So in terms of automation and transformation on AI and technology, the volatility is evident in terms of climate across the country and globe. But there's also opportunity in terms of using this landscape and basically embedding better strategies and risk mindsets to make better decisions in terms of business at the end of the day. And at Aon, we want to try and see how we can help you to get to that space. We do a yearly global risk management survey, basically per industry sector. We've got a specific one for transport and logistics, and I'll ask the team to also share it with the presentation. It's got some absolutely amazing insights. It basically also gives you a bit of a snapshot in terms of feedback globally, in terms of where the sector sees the risk sitting. So in terms of key industry, and this is both current, and then they also look at future risks. So they look at the movement of those risks within the business. So economic slowdown is rated as number one. You got cyber and data breach, which basically connect back to technology and advancements across everything, whether it's in your vehicle, in your tracking, in your systems that you use in terms of executing business. Aon is currently busy with a very exciting project in terms of delivering better confirmation and bordereaux and binding stuff for clients, and it's client interactive. It allows you to use the data better. It's basically trying to see how you can use that data better. That's going to put you apart from competition and how you manage business. And then you're going to have workforce shortage in terms of capable individuals. Regulation is always going to be on the list. And then failure to attract and retain top talent. We see quite a bit of strain in that as well. And then I think what I want to do is I don't want to jump into each slide too deeply. So I kind of just want to highlight the first 5 there, and we'll share the rest with you in the presentation, just being cautious of time. I want to allow some time for questions as well. Why cargo risk matters. So again, Russell did mention earlier in terms of high value goods, and obviously the accumulation and the sensitivity around that movement of your exposure. So, if there's high value goods and you've got an accumulation point, your risk is so much greater for that. And obviously insurers looks at those items when they underwrite a policy, and it's got an impact on your premium. Impact of disruptions, and that's basically just, again, Russell mentioned some of this in terms of shipping delays, and this is day-to-day challenges in terms of trying to see how best to build strategies around this, and make sure your insurance and risk program aligns with these type of concerns. And then complex supply chains. Again, this is no news to everybody joining this call, and we'll jump into some ideas around how we can look at that a bit differently later in the presentation. And then there's a definite need for risk strategies, or better risk strategies. So effectively managing your risk, it is a lot different from where it was 10 and 20 years ago. And I think there's also some really exciting products and initiatives in terms of looking at something like an alternative risk transfer that Russell mentioned earlier as a tool. So we'll address that a bit later in the presentation as well. Basically, just again, top cargo risk, the accumulation I mentioned, transit damage, which has also been mentioned with Russell, but it also goes through to the cargo as well. Cargo theft in South Africa remains a big risk. And then also in terms of global tariffs and contractual risk. So your contractual risk kind of being key in a big part of transport and logistics. Your contractual obligations should almost, in terms of a risk management item, should be top of list, because if you consider insurance as a mitigation tool and you mitigate your risk from an insurance perspective, it actually starts at your contractual basis. And we'll jump into that in the next few slides. Global shift is just, in terms of manufacturing hubs, again, tariff uncertainty globally, need for agile risk strategies. And again, this goes to alternative risk strategies to manage the vulnerability, whether it's in your day-to-day claims space, or in terms of your bigger long-term ideas in terms of how you'd like to structure your insurance portfolio. Let's jump into just the contractual bits. I've mentioned this a bit earlier. So extremely important then when we look at the transport and logistics sector is that clear agreements matter. And we see this daily in terms of claim stage, in terms of underwriting information. There's always the speed to market in terms of take a priority, and when it comes to agreements to get out and to be competitive and contracting with parties. I think the approach, we want to have this as a consideration as a risk. The focus needs to be on your contractual risk to make sure that your contracts with third parties are understood. It's clear that there's a good understanding in terms of where that risk transfer, what the intention is. And also, if you move cross-border, where that territorial and regulations are sitting, your jurisdiction will always play a role there. And it's crucial that you understand those challenges, especially in terms of your care, custody, control, and settlement of claims. It becomes very, very important to understand how you contract cross-border as well. And then early legal involvement. I think there's, at stages we've seen clients delaying legal involvement in terms of complexities that they can identify early, but they delay legal involvement. So from a mitigation perspective is to try and get early legal involvement if there is a risk that you can identify that needs that escalation. And then just clarity for claims efficiency. So if the contractual agreements are clear, it makes the claim flow much easier, because most of the frustration basically sits at claim stage. Everybody's running a business. You want to make sure that you get back up and you have business continuity. At the end of the day, if there's not contract certainty, and it becomes a problem at claim stage, and it causes further delays. Okay, and just mitigation actions. So, a big consideration, insurance, nobody's jumping out of bed to look at the insurance portfolios, but we want to encourage individuals to look at designing flexible insurance programs, having a strategy around that in terms of what your short-term, long-term strategy, and, get a knowledgeable broker to help you tailor that to your needs. Each company's got different needs, and it's extremely important not to just have a generic product, especially if you have complexities in your business that don't fit the generic box. Contract risk review, again, we touched on this a bit earlier, something that, one needs to look at how we can help in terms of identifying gaps. So basically, not from a legal advice perspective, but how do we make sure that your insurance portfolio dovetails with your contractual obligations? So extremely important. Otherwise, you might be insuring stuff that you're not contractually liable for, or you might have potential gaps that's actually not covered. So, the alignment of your insurance program and your contractual obligations are key to have a robust program. And then geopolitical risk will always remain a topic for us. Russell also mentioned this in terms of the riots and strikes down in KwaZulu-Natal. And it's, from an insurance industry perspective, there are certain flags and triggers that they anticipate more of those in the years to come. And then again, just looking at loss control, how do you currently deal with that loss control tools, and how do you use the data to your advantage to safeguard cargo and your security, integrity. So theft prevention strategies is also just in terms of making sure that, you kind of like address that and adapt to what data is available in the industry. I've added in, just for a matter of interest, we briefly touched on the top risks earlier, but I've basically included where global data showing transport and logistic risks sitting today. Basically what you have on your screen here, technology sitting in that cyber attacks and data breaches, which obviously can literally stop a business if you look at your system dependencies. Economic slowdown, business interruption, increasing competition. And then I've added additional slide here in terms of looking forward to 2028, which is quite interesting. Cyber kind of moves down one, and I think for good reason, because, as we've approached the whole automation and evolution of technology, you kind of see people getting a better grip of it and also implementing it in their processes and systems to run businesses better. But also at the same time, that is going to definitely create more competition and an increased competition. So just as a matter of interest, I've included both slides that you can have an idea of risks today and what it kind of like on a projected level look like in 2028. Okay, so again, sorry, the intention is not to rush, but I just want to try and see if we can leave a couple of minutes for questions. We've added this slide to show you more or less where loss of income related for the industry is sitting. So basically, where's the claim sitting? And this is not taking into account of the physical vehicle. So again, just give you a bit of a wide overview of where some of those losses are sitting compared to the top risks in the industry. I think key takeaways before we jump into risk, alternative risk transfers, to look at aligning, your financing strategy with business priorities. I think there's a big opportunity for companies to look at something like alternative risk transfer. Conventional insurance models do provide solutions. So depending on the scale of your company and your risk appetite and your long-term plans, alternative risk transfer is basically an alternative vehicle. So it's basically like a contingency fund, and it allows you to write basically your own insurance policy, and you can transfer risk into that. So the idea of this is to look at your high volume type of claims and stuff that you do have appetite for, put it into your own facility. It's currently sitting on balance sheet potentially, so moving it into alternative risk transfer tool or facility basically allow you the insurance tax deductible still, but allows you to write your own rules into that. So if you take a long-term strategy, these are models that will allow you to take some of the risk that's been carved out by the insurance market or higher deductibles to push down premiums and move it over into alternative risk transfer structure. I think also key takeaways for just high-level overview: technology, artificial intelligence, automation is definitely, you know, a big driver in terms of risk, not just in terms of competition, but it's becoming a reality that everything we touch have that type of element. So to have it as part of your risk register and to see how you incorporate, use it to your advantage, there's a lot of data available that will enable you to run your business more efficiently by using those tools. Sector-specific risk solutions, again, just looking at the supply chain, and enabling organizations to adapt quickly. I think that's the most important thing in terms of your insurance and risk program, is that agility to adapt with the environment. As I've mentioned earlier, with the technology component, Aon is busy with a few pilot clients in terms of testing a system, which is really exciting. It basically allows transport companies to issue policies on an online facility and platform, and it issues the certificates on an ongoing basis. So again, if you in that space, it allows you that flexibility to work with data better, to carve out some of the admin load. And in terms of sufficiencies, these are things where if you complete the submission, it issues the certificate in a couple of seconds back to you, and it complies with the regulations because it allows for the advice to flow through. It allows for your end client contractually to sign off and approve the quote and basically issue the confirmation of cover. We've added in a few sections in terms of just additional information around how Aon can help. Obviously, it's very client specific, and each person's got their own needs, own risk profile. Some clients are struggling more with certain elements than others, but we're always happy to have a discussion. In terms of the additional content, we've added in a bit of a high-level overview in terms of logistics products that we can offer. And again, like I mentioned, some companies are so specialized that we need to leverage potentially global markets to try and see if we can find solutions around the risk, which obviously we lean on our global footprint to look at best practice and maybe partner with Lloyd's brokers if need be. So just again, high-level products, value-added services for logistics. I've added in the components around the trucking as well, whether it's cargo, warehouse liability, errors and omission liabilities, or anything around trucking that's not reflected on this. We'll be able to have a more in-depth discussion if there's a need. And then just in terms of marine cargo, also, in terms of the hull and liabilities, cargo itself, and whether it's one-offs or putting facilities in place for yourself, contracted individuals down the line to try and make sure we plug the gaps as best possible. Just before we go over into slides, just like to play a short video, and then I think maybe we've allowed for a couple of minutes for questions and just to try and see how we can better assist in terms of something that's keeping you up at night.
Well, thank you very much, Russell
Thanks,
and
Kevin.
Philip.
Yeah, thanks, everyone.
Thank you very
Yeah,
much. Yeah.
We've got a couple of questions, so I'm going to start as they came in. And the first question, I'm not going to say who it comes from, I'm just going to read the question. Does Aon have risk heat maps of high risk areas and the type of risk, and could that be shared to assist operators to either try to not enter the risk area or apply mitigation when entering the risk area? So that's the first part of the question. Do you want me to carry on to the second part?
Kevin, let me hit that over the head. I actually got an answer for that one. So while we're at it, I think with Aon, depending on what territories you go in, yes, we do heat maps. We can do very country specific heat maps as well. And I think also a very helpful tool is that we got insights in terms of territories, the regulations, minimum requirements. So basically just assisting clients to understand that if they go into a territory, there's certain regulations and certain rules that basically apply to each of those countries. So absolute yes in terms of heat map. What I'll do is when we share the presentation, I'll ask the team to share the global risk survey. There's a few additional links in there that basically also speaks to the heat maps and a bit of additional information around that.
Cool, thanks. The second part of that question, looking at the risks, there is little reference to crime or accidents, but there is far more reference towards the broader environment. Has the crime and accident risk declined in your view?
No. So definitely not. It hasn't declined. We still have a lot of crime incidents, and I think if anybody looks at their insurance policy, you would have noticed that if we just look at a standard insurance policy where there are certain types of vehicles where the insurers are now insisting on double tracking devices because of the theft risk on those vehicles. Similarly, if you look at the types of claims that we've seen on the roads, there's a lot of vehicles being damaged, overturned, etc. There's a lot of accidents on the road. And the scary thing is there's also a lot less insured parties on the roads. So not everybody that drives a vehicle is actually insured. So when you're in an accident with a third party like that, trying to recover from them is extremely difficult. And again, these costs accumulate then towards your own insurance. It just means that you're unable to recover some of those costs from those negligent parties.
Kevin, and just to add to Russell, obviously on the cargo side, it depends on what's being transported. So your commodity will definitely be different depending on what risk you're looking at. So, for some commodities, there's very specific syndicates and really well organized. So, some individuals on the call will know exactly that they're feeling, much more of a pinch around potential thefts or hijackings, and it most definitely will relate to the commodity. And then other commodities seems to be quite lucky because, there's no risk around and there's no on-sale value, in terms of the black market. So I think it's very client specific. So in terms of trying to give you a straight answer, the answer might be different depending on what client you're talking to.
Thanks. Now I require you to get that crystal ball from your bottom drawer, polish it. There's a question. There was mention of keeping abreast of regulations. Are we to see major changes in the RAF, that's the Road Accident Fund? And would there be adaptation or innovative solutions to counter the RAF from an insurer's perspective, such as updated offerings in terms of personal accident cover?
I'll take a stab at it. Russell also want to do this. So I think, when you look at it from a client side, so if I'm sitting on the client side of the desk, if you're going to leave your risk up to regulations to be covered, you need to understand that there's a risk in doing that in itself as well. So, we look at some clients that basically consider that, yes, it's there, but they would rather take out an insurance product to make sure that they basically take proactive steps because of past experiences. So again, it depends on the client's risk appetite. It depends on the client's approach. Some clients are very much premium sensitive and, focus in terms of cost saving, which obviously there's a priority list in that when it comes to insurance. Again, insurance being a grudge payment until you need it. So it depends on the risk mythology actually and how you want to approach these things. From our side, looking at a crystal ball, if you want to consider long-term risk strategy, I would definitely say consider having a discussion with your broker around those things. In my views, and you can't always rely on regulations to plug your risk the way it's expected to. Maybe let me leave it at that. I'm not sure if Russell.
I think it's also it's all about there are products available. It's discussing it with your broker and making sure that we present those solutions to yourselves. So certain transporters, especially in the passenger transport industry, they actually want to look after the passengers. So they make sure that there is a personal accident type of insurance in place for in case an incident happened and a passenger within the vehicle is injured as a result. So they want to make sure that there is coverage in place, but also reactions in place. So, there's a company that can immediately take action, take people to hospital, address the hospital need, the costs, etc. So there are clients that's already taking that action in place, and there are solutions available out there.
Great, thanks, gents. And then the last one, let's say a truck is in an accident or a crash. How is the decision to replace or fix handled? So to repair the vehicle. Is it the prerogative to put the customer in the same position as he or she was before? Or is it a mere cost of repair versus costs of replace decision? To elaborate, at which point is the decision to write off made?
Yeah, so it is unfortunately the value of the loss. So is it going to cost the insurer more to repair the vehicle than it would be then to pay out? But it's also, you need to look at the age of the vehicle, the damages to the vehicle, and they've got specialist assessors that go out, they determine the cost of repairing versus actually saying, let's rather give up on trying to repair this vehicle, let's rather write it off, and we give you a sum of money so that you can buy a new vehicle that's better technology, etc. You won't be put into the same position because they'll only settle the amount of the retail value of the vehicle, and to try and buy a new vehicle will cost you double the amount of money or whatever. But yes, there is assessors involved in making that, making the assessment of the value of the claim, and then the insurer. And also in a lot of situations, we've got the client that actually also discusses this claim scenario and the payout scenario, and would rather have the vehicle written off, get a settlement so that they can buy a vehicle. So it's all about discussions with the insurer as well at that point in time. It's the need for the client that needs to be, we need to align both parties, the insurer as well as the client.
And I think maybe just to add there is that, if there's a certain expectation in terms of how the policy would or should respond, is to have an upfront discussion with your broker. So basically to look at, a claims or loss scenario and say, well, look, let's hypothetical say this happens. How's my policy respond, to make sure that it aligns with your expectations? So each insurer obviously might have a different stance. So it's not to try and avoid the question, but you might end up having one insurer having a very specific approach in terms of repair, where another one might be more flexible. So I think from an advice or recommendation perspective, I would say, have a discussion with your broker and, pull in the insurer and have a claim scenario where you get to manage your own expectations around that. Because what will happen is usually, at claim stage, the expectation does not align and it causes a lot of frustration.
Thanks very much. Then the final question, in terms of cross-border logistics and the heat maps that you mentioned earlier, how would the broker or insurer notify clients of potential risk areas?
So I think there's different ways, depending on the insurer, and there's also systems that do these type of things. So, we need to take from our side, we'll do a once-off report, and we can basically refresh that report on an ongoing basis, but it won't push out necessarily notifications on a daily basis. There is subscriptions to third parties that will allow for that. And then again, there's system integration as well that one can consider. But I think the key there is from Aon side is we'll take a snapshot in terms of your operating territories. We'll give you a heat map for that. So in terms of live information, there's definitely third parties that specialize in that. So if the need is basically to plug into that live data, it's definitely available. I'm happy to share what we do from Aon side, try and see if we can meet, the needs, and if not, to try and see if we can put you in touch with companies that can share that type of data.
And there's definitely a lot of investment made by some of the insurers. I don't know. I regularly receive a SMS notification from my insurer to say that hailstorm potentially coming into the area. Try and make sure that you protect your vehicle. And a lot of the other insurers, especially when it comes to trucking, they've also invested on big data rooms, and they actually monitor vehicles, and they also look at potential risk areas, and they would immediately notify the client saying, we can see that your vehicle is actually moving into an area that is deemed to be a high risk at this moment in time. Please try and make sure that you protect or divert or do something about that.
Kevin, interesting just on that topic is that you'll see in terms of travel policy, so just your general travel policy that you can get in the market, Chubb and TRC's got live data. So they will basically warn their clients in terms of should there be potential risk around the countries or territories that clients are traveling to. So again, like Russell mentioned, there's some insurers that's better at this. There's third parties that specialize in it. We're more than happy to try and give you a bit of an idea of what we do with our heat maps. Hopefully it will be of some help.
Thanks very much, gents. Philip, Russell, we've come to the end of the allocated time. I'm sure if there are more questions, we'll get them through to you. But we appreciate your time, your expertise, and answering questions. And thank you very much to everyone who was on the webinar. Stay safe out there, and we look forward to chatting again sometime. Thank you very much.
Thanks, Kevin.
Thank you very much. Bye.
Cheers. Bye.